A real estate exchange-traded fund is a type of investment fund that specifically focuses on companies involved in real estate ownership, management, or financing. These ETFs offer investors the opportunity to invest in a wide range of real estate companies, including REITs, real estate development firms, and homebuilding companies. By investing in a real estate ETF, investors can enjoy the benefits of a diversified portfolio of real estate investments while having the convenience of buying and selling shares on an exchange. The primary objective of real estate ETFs is to provide a user-friendly and accessible means for investors to participate in the real estate market. Real estate ETFs present the potential for capital appreciation and income similar to individual real estate investments, but with reduced risks and increased diversification. Furthermore, these ETFs offer advantages such as liquidity, cost-effectiveness, and transparency. Given that real estate has historically delivered favorable returns and demonstrated low correlations with other asset classes like stocks and bonds, it holds significant importance within many investors' portfolios. Real estate ETFs enable investors to access the real estate market with less risk and improved diversification compared to investing in individual real estate assets. Additionally, real estate ETFs serve as an efficient method to gain exposure to specific real estate sectors, such as residential or commercial real estate, or specific geographic regions. Types of real estate ETFs. Real estate ETFs can be categorized into three primary types: equity real estate ETFs, mortgage real estate ETFs, and hybrid real estate ETFs. Equity real estate ETFs. Equity real estate ETFs allocate their investments towards companies that own and manage real estate properties, such as REITs and real estate development firms. These companies generate revenue through property rentals, leases, or sales. By investing in equity real estate ETFs, investors can gain exposure to the real estate market, along with the potential for capital appreciation and income. Mortgage real estate ETFs. Mortgage real estate ETFs focus on companies that invest in mortgages or mortgage-backed securities. These companies generate revenue from the interest and principal payments associated with the mortgages they hold. Investing in mortgage real estate ETFs offers investors exposure to the real estate market and the potential for generating income. Hybrid real estate ETFs. Hybrid real estate ETFs employ a combination of investments in both equity and mortgage real estate investment trusts. These ETFs offer investors exposure to both the equity and debt aspects of the real estate market. By investing in hybrid real estate ETFs, investors can diversify their exposure and benefit from both the potential for capital appreciation and income generation within the real estate market. Overall, these different types of real estate ETFs provide investors with various options to participate in the real estate market, catering to different investment objectives and risk profiles. Advantages of real estate ETFs. Real estate ETFs offer several notable advantages compared to individual real estate investments, including diversification, cost-effectiveness, liquidity, and transparency. Diversification. Real estate ETFs provide investors with the opportunity to diversify their holdings across a portfolio of real estate companies. This diversification spans various sectors and geographic regions within the real estate market. By spreading investments across multiple companies, the risk associated with investing in a single real estate company or property is mitigated. Lower costs. Real estate ETFs generally incur lower fees and expenses compared to individual real estate investments. This is primarily due to the efficiency of trading securities within an ETF structure as opposed to transacting in individual properties. Additionally, real estate ETFs benefit from economies of scale, which can lead to reduced trading costs. Liquidity. Real estate ETFs are traded on stock exchanges, just like other exchange-traded funds. This inherent exchange-traded nature of real estate ETFs ensures high liquidity, allowing investors to easily buy or sell shares at any point during the trading day. This convenience enables investors to participate in the real estate market without the challenges associated with buying and selling individual properties. Transparency. Real estate ETFs are subject to regulatory requirements that mandate regular disclosure of their holdings. This transparency enables investors to have a clear and comprehensive understanding of the underlying securities within the ETF's portfolio. By having access to this information, investors can make informed decisions regarding their investment choices and portfolio management strategies. Overall, real estate ETFs offer investors the advantages of diversification, cost efficiency, liquidity, and transparency, making them an attractive option for those seeking exposure to the real estate market. Risks of real estate ETFs. Despite the numerous advantages offered by real estate ETFs, investors need to be aware of the associated risks. The main risks that investors should consider when investing in real estate ETFs include market risks, interest rate risks, credit risks, and liquidity risks. Market risks. Real estate ETFs are exposed to market risks, which encompass factors like economic downturns, changes in interest rates, and geopolitical events. These risks have the potential to cause a decline in real estate values, leading to losses for investors. Interest rate risks. Real estate values are sensitive to changes in interest rates, impacting both the cost of borrowing and the demand for real estate. When interest rates rise, borrowing costs increase, which can decrease the demand for real estate and subsequently lower its value. Real estate ETFs that invest in real estate companies may be affected by these interest rate fluctuations. Credit risks. Real estate companies that issue debt securities are exposed to credit risks, such as the possibility of default or bankruptcy. If a real estate company fails to meet its debt obligations, it can hurt the performance of real estate ETFs that have invested in that particular company. Liquidity risks. While real estate ETFs themselves are typically highly liquid due to being traded on exchanges, the underlying securities in the ETF's portfolio may not share the same level of liquidity. This discrepancy in liquidity can pose risks for investors, especially during periods of market stress or volatility, when selling shares might be challenging or result in unfavorable prices. It is crucial for investors to thoroughly assess these risks and consider their risk tolerance and investment objectives before investing in real estate ETFs. Conducting proper due diligence and consulting with financial professionals can help investors make informed decisions. Factors to consider when choosing real estate ETFs. When selecting a real estate ETF, investors should carefully evaluate several factors that can significantly impact their investment decisions. These factors include asset allocation, expense ratio, liquidity, performance history, and the expertise of the management team. Asset allocation. Investors should assess the asset allocation strategy employed by the real estate ETF. This involves understanding the types of real estate companies and geographic regions included in the portfolio. Aligning the ETF's asset allocation with its investment goals and risk tolerance is crucial for investors. Expense ratio. Investors should consider the expense ratio associated with the real estate ETF. A lower expense ratio can enhance net returns for investors over the long term, making it an important factor to evaluate. Liquidity. The liquidity of the real estate ETF is another crucial aspect. Investors should ensure that the ETF has ample trading volume and tight bid-ask spreads, enabling them to buy or sell shares without incurring significant costs or encountering liquidity challenges. Performance history. Reviewing the historical performance of the real estate ETF is essential. Investors should examine the ETF's returns and volatility over different market conditions to gain insights into its past performance and assess its suitability for their investment objectives. Management team. The expertise and track record of the management team behind the real estate ETF should be evaluated. Investors should consider the experience of the portfolio managers, their approach to investing, and the overall investment strategy. A skilled and knowledgeable management team can contribute to the success and effectiveness of the ETF. By thoroughly analyzing these factors, investors can make well-informed decisions when selecting a real estate ETF that aligns with their investment objectives and risk preferences. Conducting thorough due diligence and seeking professional advice can further enhance the decision-making process. Conclusion. Real estate ETFs have gained significant popularity among investors as they offer a means to access the real estate market with reduced risk and enhanced diversification. These ETFs provide several advantages, including diversification, cost-effectiveness, liquidity, and transparency. Diversification allows investors to spread their investments across a variety of real estate companies and properties, reducing their exposure to any single entity or asset. This diversification helps mitigate risks and enhances the potential for stable returns. Real estate ETFs generally have lower costs compared to individual real estate investments. This is primarily due to the operational efficiencies and economies of scale achieved through ETF structures, resulting in cost savings for investors. Liquidity is a key advantage of real estate ETFs. They are traded on exchanges, offering investors the flexibility to buy and sell shares throughout the trading day. This high level of liquidity ensures ease of transactions and provides investors with the ability to react to changing market conditions. Transparency is another valuable aspect of real estate ETFs. These ETFs are required to disclose their holdings regularly, enabling investors to have visibility into the underlying securities within the portfolio. This transparency empowers investors to make well-informed decisions and monitor their investments effectively. However, investors need to be aware of the risks associated with real estate ETFs. Market risks, interest rate risks, credit risks, and liquidity risks are factors that investors should consider before investing in these ETFs. When selecting a real estate ETF, investors should evaluate key factors such as asset allocation, expense ratio, liquidity, performance history, and the expertise of the management team. These factors play a crucial role in determining the suitability of an ETF to meet investors' specific investment goals and risk appetite. Overall, real estate ETFs offer a valuable opportunity to diversify investment portfolios, access the real estate market, and potentially achieve long-term returns. It is essential for investors to carefully assess the advantages and risks associated with these ETFs to make informed investment decisions. We hope this video has provided you with a comprehensive understanding of real estate ETFs and their advantages. If you're interested in learning more about real estate investment trusts and exploring their pros and cons, we encourage you to click on the video displayed on your screen. It will provide you with a detailed analysis and further insights into REITs. Don't forget to like this video, subscribe to our channel for more informative content, and hit the notification bell to stay updated with our latest videos. Thank you again for watching.